is bullish on technology and medical technology stocks. He says we're transitioning from an interest rate-driven market to an earnings-driven market. Michael Sutton, Chief Investment Officer at Pilgrim Baxter, joins us now for the firm in Wayne, Pennsylvania. Thanks for joining us from Wayne, Pennsylvania. Appreciate it very much. Michael, why are we transitioning to away from into an earnings-based environment right now? It seems like everybody's talking about rates.
Well, everybody is talking about rates, and they have been for quite some time. And bonds have been an attractive alternative for many people, but now we're moving into the part of the cycle where rates, by most people's measures, are going to start heading up. And we've seen some early signs that employment is starting to improve. We had a durable goods order last Friday up 3.4%. And what that shows us is the strength from consumer is now moving into strength in businesses.
If you look at what the notes are, you had told our producers earlier, you said you are significantly overweighted in technology since July. Let's just be specific here. What exactly is significantly overweighted for your portfolio in terms of percentages?
Well, I run a number of different portfolios, but the large cap growth product that we're talking about here, everybody looks relative to their benchmark, and the benchmark for this particular product is a Russell 1000 growth, which is roughly about 28% in technology stocks, and we're close to 40% technology exposure in this portfolio.
If I look at the market, the S&P 500, over the past 6 months, though, infotech has been the worst performing group, up 7% versus 20% for energy, 16% for telcos.
Well, telco doesn't make up all of technology, and a lot of the companies that we own in the technology space, such as eBay and Yahoo, have done very, very well over that period of time.
So as far as medical technology, are there any particular names that you find attractive giving your earnings recovery scenario?
Well, we've owned Boston Scientific for a very long time, anticipating the taxes for approval for the drug-coated stent. That happened about a month ago. Other companies that we like in the space include Zimmer, which just reported a very strong number tonight, beating estimates by between 3 and 5 cents. Again, they do hip replacements, and there's a large growing market for people as they grow older to have those kind of operations.
Now, as far as your overweight percentage there, what would be your benchmark, if you will, and how much overweighted are you in medical technology right now?
In medical technology, the benchmark is somewhere in the neighborhood of 16%, and we're probably 20%.
Okay, so 25% overweighted the benchmark if you want to do percentages of percentages. So you're not that concerned about interest rates, but you have to, of course, pay attention to them, or do you not even?
Well, I really don't try to focus on economic ideas. What I try to focus on is a very bottom-up driven analysis where I look at companies that exhibit strong earnings or business momentum. If we can see a company whose revenues are growing very strong and whose earnings are growing very strong and that are exceeding the consensus expectations, very much like Zimmer just did today, those are the kind of companies we're interested in.
Let's talk about Apollo Group, the parent company of the University of Phoenix. That's one of your core holdings, one of your favorite picks. Look at that, 81.5% 12-month gain. The stock is really hot, no question about it. What's going to drive this thing higher?
Well, education is a growth business, and this is a $16 billion company, and it's really leveraging the internet to generate leads for new students. It's a very cost-effective way to do it. The long-term earnings and revenue growth on this company are north of 30%. The return on invested capital is about 50%. We're looking at online population growth of 58%. This is the 15th quarter in a row that they've reported over 50% growth in that segment.
I could say, though, it's trading at 53 times next year's earnings, so perhaps it's already in the stock.
Well, clearly there's good news in the stock, and again, what I look for is companies that exceed expectations. So they almost always look expensive. We're not scared away by that because, quite frankly, when I bought the company 140% ago, a lot of people thought it was expensive then. So as long as you continue to put up the numbers, it'll earn that multiple that it's trading at.
All right, Michael Sutton, thanks very much. I'll just tell our viewers that Apollo for the past 6 quarters has had an average earnings per share surprise of 15%. Michael Sutton is Chief Investment Officer at Pilgrim Baxter, PBGH, the brand name of their funds. Americans were in the mood to buy homes last